Okay, let's unpack this deep dive. We've got some really interesting material here, focusing on Goldman Sachs, specifically their 2015 shareholder letter and, related context.
That's right. It's like stepping back, what, almost a decade? To see what a major global financial player was dealing with, thinking about, prioritizing.
A snapshot in time. And the sources describe the environment back then in 2015. They call it a tale of two halves.
Yeah, I like that description too. It sums it up pretty well. The first half of the year was actually quite strong for them.
Strong how? What was working?
Well, the sources mention heightened demand, especially from corporates looking for strategic advice, help with financing deals, plus solid client activity in their equities business and growing interest in investment management.
So things were looking pretty good initially.
Definitely. They actually hit record first half results in investment banking and investment management. And equities had its best first half in 6 years. So, yeah, a really strong start.
But then the second half of the tale kicks in. The sources mention significant headwinds. What changed?
A bunch of global stuff started to bite. You had growing worries about China's economy, the Fed hiking rates for the first time in, well, nearly a decade. That was a big deal.
I remember that anticipation.
Exactly. Plus, just generally slowing global growth, falling commodity prices, oil especially, and all that meant clients became less active in the second half. Things cooled off.
Right, so a real shift in the climate they were operating in. Our mission here for you listening is to really cut through the corporate speak in this letter. We want to pull out the key insights.
Yeah, understand Goldman's position, their strategy, how they actually performed financially, and what their outlook was then based on what they told shareholders directly.
Because these letters, they're valuable, right, for understanding a company's thinking long term.
They really are. Management has to lay out their view, face the challenges, share their vision. It's a direct line. So we're digging into that specific communication from 2015.
Okay, let's get into it then. The numbers first. What were the headline financial results for 2015, according to the letter?
Okay, so for the full year, net revenues were $33.82 billion. And interestingly, they point out this was the fourth year in a row around that $34 billion mark. So some stability there despite everything.
Okay, $34 billion revenue, pretty stable. What about earnings?
Net earnings came in at $6.08 billion. Diluted earnings per share, EPS, was $12.14, and their return on equity, ROE, was 7.4% for the year.
7.4% ROE seems okay. But those sources flag something huge that hit these numbers, right? That RMBS settlement.
Oh, yeah, that was massive. A really significant one-off item. They booked provisions of $5.06 billion during 2015.
$5 billion. For what exactly?
It was related to an agreement with the U.S. government's RMBS working group, settling claims about their role in residential mortgage-backed securities, leading up to the financial crisis, specifically 2005 to 2007.
And that $5 billion broke down how?
It included a civil penalty of $2.39 billion, another $875 million in cash payments, and then a pretty substantial $1.8 billion earmarked for consumer relief measures.
Wow. That's a huge chunk out of earnings. What would the ROE have looked like if you stripped that out? Did they say?
They did. The letter states pretty clearly that excluding those provisions, the ROE would have been 3.8 percentage points higher.
So add that back. We're looking at an underlying ROE closer to, what, 11.2%?
Exactly. That gives you a much better feel for the core business profitability that year. It shows just how much that settlement charge, as an extraordinary item, kind of masked the underlying resilience.
That definitely puts the 7.4% in context. And this tale of two halves thing, did that show up in the business lines too?
Absolutely. That strong first half we talked about, driven by M&A, solid equity markets, growth in asset management,
Yeah.
that led to those record or near record results early on.
But then the headwinds hit.
Right. Second half, those worries about China, commodities falling, the Fed rate hike, client activity just slowed down. And that impacted revenues compared to the strong start.
Yet, they still managed relatively stable net revenues around that $34 billion mark, even with the settlement hit and the second half slowdown. What did they credit that stability to?
A key theme in the letter is their strong and diversified client franchise. Basically, having broad reach across different businesses,
Right.
M&A, asset management, trading, and serving many different clients globally helps smooth things out.
So diversification cushioned the blow.
That's the argument. When one area slowed, others might still be active. It provided more stability than maybe a more narrowly focused firm would have seen.
Makes sense. Okay, let's pivot from the numbers to strategy. The letter really emphasizes distinguishing between structural factors and cyclical factors. Why was that so important for them in 2015?
Yeah, this is crucial for understanding their long-term thinking. Structural factors are the big, often permanent shifts. Think of major regulations after the 2008 crisis. Those aren't just going away.
Right, the new landscape.
Exactly. Then you have cyclical factors, the normal ups and downs of the economy, interest rates, growth spurts, slowdowns. They needed a strategy that adapted to the permanent structural changes while also being ready for the cyclical tides to eventually turn.
So, managing the new reality while staying flexible for the future.
Precisely. You ignore the structural stuff at your peril long term. But if you're not ready for the cycle to turn, you miss huge opportunities.
Okay, so what were the big structural changes they highlighted making, mostly driven by regulation?
They detailed some major shifts since late 2007. They'd cut their balance sheet size by about a quarter, nearly doubled common shareholders' equity, strengthening the capital base,
Mm-hmm.
cut gross leverage by over 60%.
60% leverage reduction, wow.
And maybe most importantly, they tripled their liquidity buffer, held almost $200 billion in high-quality liquid assets by the end of 2015.
Tripling liquidity, $200 billion. That speaks volumes about the post-crisis regulatory world, doesn't it?
Absolutely. It's a direct response to rules like Basel III, demanding much higher capital and big liquidity reserves. These were fundamental structural changes to make the firm safer, sounder, less likely to face a liquidity squeeze.
And did these structural changes also lead to shifts in their business mix?
Yes, definitely. They talked about strategically selling off some non-core businesses and investments, partly driven by these new capital rules, making some activities less attractive.
So not just shrinking, but reshaping.
Exactly. They pointed out that investment banking and investment management together made up 39% of their net revenues in 2015. That was up significantly from just 30% back in 2012.
And investment banking relative to FICC, fixed income, currencies, commodities.
Right. IB, which was only about half the size of FICC just 4 years earlier, had become much more balanced in its contribution compared to FICC.
Does that mean they were pulling back from FICC?
The letter is careful to say no, not abandoning it. They stress being committed to FICC and their clients there. But the structural changes, especially those risk-based capital rules, meant they had to significantly reduce the amount of risk-weighted assets tied up in FICC over the preceding years. It was about adapting that core business, not ditching it.
Got it. Adapting FICC to the new rules. So that's the structural side. What about the cyclical side in 2015? What was their view?
They acknowledged it was tough. Prolonged, low, even negative interest rates globally, persistent worries about growth, deflation. But underlying that was a strong belief that, cycles do turn.
They expected things to eventually normalize.
That was the core belief. So the strategy was manage through the current cyclical downturn, which was hitting client activity, but keep the business position to really capitalize when a growth in markets inevitably picked up again, balancing that near-term caution with longer-term readiness.
Structural adaptation, cyclical flexibility. Key themes. Okay, let's look inside the firm. Costs and people. What was the story on cost management?
A continued, pretty intense focus on operating efficiency. That was clear.
But here's something interesting. The sources say headcount actually grew by 11% over the 4 years leading up to 2015. How do you square increased staff with cost cutting?
Yeah, that seems contradictory, right? But the letter explains it. A big chunk of that headcount growth was driven purely by the need to meet all the new, complex regulatory and compliance requirements. They just needed more bodies focused on that.
The cost of compliance.
Exactly. But they managed the overall cost burden effectively, despite adding those people. They used a couple of specific strategies.
Okay, what were they?
First, they shifted the mix of employees, more junior staff. The number of analysts, associates, VPs went up 17% since 2012, but the number of partners and managing directors actually decreased by 2%.
So changing the seniority profile, what else?
Location strategy was huge, moving roles and functions to lower-cost centers globally. By 2015, about a quarter of their total staff were in places like Salt Lake City, Dallas, Irving here in the U.S., or Warsaw, Singapore, Bengaluru internationally.
Right, utilizing those hubs. So more junior staff, strategic locations. What was the net effect on compensation costs over those 4 years?
Get this. Despite the 11% increase in total staff, overall compensation and benefits expenses actually declined by about $270 million over that 4-year period.
Wow. Saving $270 million while adding staff, mostly for compliance. That's pretty effective cost management. What was the plan for costs going forward from 2015?
Basically, keep doing more of the same. Continue looking for efficiencies, scrutinizing expenses.
Hmm.
But, and this is important, always balancing that against the need to invest enough to capture market share and future growth, not just cutting for cutting's sake.
That balance is key. Okay, let's drill down into the main business segments. Investment banking, how did that look in 2015?
Investment banking was a real bright spot. The letter highlights it as a leading franchise. It delivered its second highest net revenues ever in 2015, and that was largely driven by a very strong year in M&A, mergers and acquisitions.
How strong compared to the overall market?
The numbers are pretty stark. The overall M&A market volume was up, like over 45% in 2015, which is huge. But Goldman Sachs's M&A volumes were up approximately 80%.
80%. So they significantly outperformed the market surge.
Massively. They finished the year ranked #1 globally in both announced and completed M&A deals. And they had a record gap over $350 billion higher between their completed deal volume and the #2 competitor. Just dominant.
That level of dominance in M&A really says something about their client relationships and execution, doesn't it?
Absolutely. It shows they weren't just riding the M&A wave, they were actively taking share and leading the biggest deals. They also noted they thought M&A still had room to run.
Okay, M&A was booming. What about the other side of investment banking, underwriting stocks and bonds?
That was a bit softer. Total underwriting revenues declined in 2015, mainly because equity and debt markets weakened in that second half. But even so, they still ranked first globally in equity offerings, IPOs, follow-ons, etc.
Still #1 in equity, despite the slowdown.
Yeah, and they felt there was pent-up demand there, waiting for better market conditions. The decline in debt underwriting was more specific, linked to a drop in leveraged finance activity, which cooled off in the second half.
Got it. Strong M&A, #1 in equity underwriting, softer debt. Now, Institutional Client Services, ICS, which covers FICC and equities trading, how did they frame that business?
They positioned it as a core competitive advantage, being one of the few firms left with truly leading global franchises in both FICC and equities. Offering clients that integrated capability across markets was seen as a key differentiator.
Makes sense. How did FICC specifically perform in that environment?
It was mixed. Lower client activity, especially in credit mortgage products, again, those headwinds we talked about that hurt revenues there. But that was partly offset by a stronger performance in what they call macro products, things like interest rates and currencies. Maybe the volatility there create more opportunities.
And equities trading.
Equities had a more solid year overall, benefited from a generally better market backdrop than FICC did. And the firm believes clients really value their integrated platform, electronic trading, cash, derivatives, prime brokerage, all tied together globally.
So strategically for ICS, what was the focus looking ahead from 2015, given those structural changes and cyclical conditions?
It was really about continuing to adapt to the big structural shifts, especially those risk-based capital rules that were reshaping trading. They aimed to sort of advance their franchise within that new reality.
Did they see opportunity there?
Yes, potentially. Right. They noted some competitors were pulling back from certain areas, which could open doors for them to gain share over the long run. Cyclically, the plan was to scale the business carefully with market conditions, but stay positioned to capture the upside when the economy eventually improved.
Adapting structurally, positioning cyclically. Okay. Next up, investing and lending. What role did this play for the firm?
Kind of multifaceted. The letter says it enhances client relationships, creates synergies with other parts of the bank, allows them to lend to or invest alongside clients. And more broadly, they see it as participating in allocating capital for economic growth.
How had this I&L business changed leading up to 2015?
Quite significantly in its composition. Lending had actually tripled since the start of 2012, mostly focused on private wealth clients and corporations. The investment portfolio itself was pretty diverse: corporate loans, a large private equity portfolio with over 800 investments globally, public stocks, real estate, seeding new funds.
Did regulations impact this area too, and how did they view its overall contribution?
Yes, they acknowledged regulations could change the nature of their investing over time. And they were upfront that revenues here can be volatile quarter to quarter because they depend on market prices. But they explicitly stated that looking over the previous 4 years, these activities had been strong contributors to returns.
So maybe lumpy, but valuable historically and also adapting. Last big segment, investment management. Asset management, how is that doing?
This was clearly a major growth engine and strategic focus. They positioned it as a leading global franchise serving all sorts of clients. The core strategy, providing top-tier advice, products, and services, aiming for outperformance over time.
And the growth. Were they attracting assets?
Big time. They ended 2015 with a record $1.25 trillion in assets under supervision AUM. That was up massively from $895 billion at the start of 2012.
Wow, $1.25 trillion. Where did that growth come from?
A lot of it was organic net inflows from clients. They attracted $53 billion in organic long-term net inflows just in 2015 alone. And they pointed out that their inflow rate was better than their largest active management competitors, so clearly gaining market share.
Was there still room to grow, even at that size?
They definitely thought so. They felt in many areas they were still relatively small compared to the absolute biggest players, so lots of opportunity to gain more share and expand into new product areas.
Like what kind of new product?
They highlighted things launched over the previous 4 years that had already attracted over $50 billion in assets. Stuff like their active beta strategies, unconstrained fixed income funds, income-oriented strategies. Innovation was key.
Were acquisitions part of the picture in investment management?
Yes, they've done 8 acquisitions since 2012, bringing in over $70 billion in assets and adding new capabilities. They mentioned buying Imprint Capital Advisors in 2015 specifically to boost their ESG, environmental, social, governance investing capabilities, which was clearly a growing area, and they said they'd keep looking for more targeted deals.
Okay, so investment management, strong growth, gaining share, innovating, using acquisitions, a real powerhouse. Let's shift gears to something underlying all of this, technology. How important was tech, according to the letter?
Hugely important. They called it a critical differentiator. And the scale of their investment really backed that up. About a quarter of their entire workforce was in technology roles.
1 in 4 employees in tech. That's a massive commitment. How do they explain why tech was so critical?
Several ways. First, obviously, improving the client experience. Faster execution, smoother transactions, better data and analytics, quicker communication, all that stuff.
Makes sense. What else?
Second, making the firm itself more efficient. Using more open-source software. Adopting cloud strategies to cut down on what they spent with external tech vendors. Just running leaner internally.
Okay, client experience, internal efficiency.
Third, meeting all those heavy regulatory requirements we talked about, Dodd-Frank, Basel III, building the software and automating the processes needed for compliance was a massive tech effort. They even noted that some tech staff hired for this could potentially be shifted elsewhere later once the systems were built.
Right, the regulatory tech build. And
Fourth, actually creating standalone tech products they could potentially commercialize. They had a history here mentioning things like TradeWeb, Direct Edge, Market, that they helped build and then spin off or sell stakes in.
so tech could be a business in itself.
Potentially. They also highlighted newer platforms they were building. Symphony, a communication platform that started internally but became its own company. And Marquee, which was a platform for building tools directly for clients, risk management, analytics, that sort of thing.
So tech was really woven into everything. Client service, efficiency, compliance, even new product development. Foundational. Beyond the core business lines in tech, the sources also touch on impact investing and broader initiatives. What did they highlight there?
Yeah, they made a point of emphasizing their commitment to, fostering positive change in the economy in communities using their specific expertise and capital.
What were some examples?
The Urban Investment Group, UIG, got a specific mention. It had been around since 2001, investing in underserved U.S. communities. By 2015, it had committed over $4.9 billion, helping finance thousands of affordable housing units, community facilities, commercial space, often working with local nonprofits and public sector partners.
So direct community investment.
Right. And they were pioneers in social impact bonds in the U.S., too. Also, environmental impact was big. Building on a policy framework from 2005, they were focused on financing climate solutions. They'd massively increased their target for clean energy finance and investment to $150 billion by 2025.
$150 billion target. Wow. Any operational goals?
Yeah, aiming to be carbon neutral starting in 2015 and targeting 100% renewable power for their own operations by 2020. Concrete goals.
Okay, UIG, environment.
What?
What about initiatives focused on people, entrepreneurs?
2 big ones highlighted.
Yeah.
First, the 10,000 Women Initiative. Global program, 56 countries, providing education, mentoring, networking, access to capital for women entrepreneurs.
What kind of impact did that have?
The reported results were pretty impressive. Participants seeing big revenue increases, adding jobs, doubling workforces, and a multiplier effect. 90% went on to mentor others. They also set up a finance facility with the IFC to channel hundreds of millions specifically to banks lending to women-owned businesses globally.
So 10,000 women globally. What was the other one?
10,000 small businesses, focused on the U.S. and U.K. Similar model. Education, support, access to capital for established small business owners. Served over 6,000 owners by then. committed significant capital through partners, high graduation rate, and again, graduates reporting strong revenue growth and job creation.
These sound like pretty substantial commitments alongside the main banking business. Let's talk about the people inside the firm. Leadership, culture, talent. The letter calls talent vital.
Absolutely calls it, if not the vital competitive advantage, especially in such a fast-changing industry. They frame the business as being fundamentally about relationships with clients and internally too. So getting and keeping the best people is everything.
How did they attract talent back then?
They highlighted a very low acceptance rate, only 4% for open roles in 2015, but a very high offer acceptance rate, over 80%, suggesting the firm was still a highly desirable place to work.
Were they just competing with other banks for talent?
No, they explicitly mentioned competing beyond finance, especially for tech talent. They felt their culture, client service, teamwork, striving for excellence was a key differentiator. Plus, the idea that the work itself is consequential, allocating capital, managing risk, playing a role in the economy, they believed that appealed to people who wanted to make an impact.
Did they get any external recognition for that culture?
Yeah, they mentioned being on Fortune's 100 Best Companies to Work For and Most Admired Companies lists, plus Working Mothers list for Best Companies for Women and Multicultural Women in 2015. So some validation there.
Okay, attracting talent was key. What about developing it internally, building leaders?
Huge emphasis on that. Investing in people early to build the next generation. They'd launched specific initiatives for junior employees in 2015, based on feedback from internal surveys, things focused on flexibility, more client exposure.
And promoting from within.
Definitely. They highlighted their 2015 managing director class, diverse group from over 40 countries, and significantly, 40% of them had started at the firm as analysts. They saw that as proof of their focus on developing and keeping talent long-term.
That internal pipeline sounds crucial. Okay, final stretch. Looking ahead from that 2015 vantage point, the letter directly asks, how do we navigate uncertain times? What were the big uncertainties they saw then?
A whole list. Concerns about global growth, shaky investor sentiment, ongoing debates about regulation and monetary policy, tricky geopolitical stuff, specific examples, China's slowdown, the upcoming U.S. election, the possibility of UK-EU referendum, Brexit market volatility, conflicts.
So a lot swirling around.
Yeah, and even fundamental questions becoming mainstream, like technology replacing jobs or whether central banks were running out of ammo. A complex picture.
Definitely complex. How did they say they approached managing risk and advising clients in that kind of world?
As risk managers, they said they were constantly grappling with these issues. The approach was understand the uncertainties deeply and prepare clients and prepare the firm itself, even for scenarios that seemed unlikely but could have huge consequences, those tail risks.
What kind of risks were they worried about?
They mentioned things like deflation, potential liquidity problems, maybe stemming from new regulations, how China's big economic shift would play out, emerging markets' exposure to falling commodity prices. The idea was to use all their resources to help clients navigate and constantly stress test the firm against potential shocks.
So a very cautious, risk-focused stance. But was it all doom and gloom? Did they see any reasons for optimism?
Yes, they definitely balanced the caution. They pointed to some positives. The U.S. economy nearing full employment, maybe some early signs of inflation picking up, markets stabilizing a bit, and a really strong core belief that zero or negative interest rates were not the new normal. They just couldn't be, fundamentally.
They expected normalization eventually.
Right. They also argued China's slower growth was still substantial growth for an economy that size.
Yeah.
And they saw potential for more government spending, fiscal policy in some countries, and believed central banks still had options if growth faltered. So, not giving up hope.
Acknowledging the challenges, but holding on to some fundamental optimism. How did the letter come across in terms of communication with shareholders?
Pretty transparent, I'd say. Directly addressing the headwinds, the big RMBS settlement impact. They made forward-looking statements about goals delivering long-term value, aiming for best-in-class returns. They also highlighted returning capital about $25 billion over the previous 4 years via dividends and buybacks, pointing to a big dividend increase and shrinking the share count.
So trying to keep long-term investors informed.
The level of detail on strategy throughout the letter really suggests that was the aim, engaging shareholders on how they were managing through both the structural shifts and the cyclical pressures.
So wrapping up, what was the overall outlook conveyed in that 2015 letter?
I think it was. Expect the near term to stay challenging. Focus on costs, focus on strategic priorities, but longer term, generally optimistic. confident that by sticking to their strategy, adapting quickly, and really focusing on client needs, they could navigate the uncertainty and deliver strong returns over time.
Mm.
It paints a picture of a firm very aware of the major challenges, both outside and inside, but fundamentally confident in its core strengths and its ability to adapt and ultimately succeed.
Yeah, this deep dive into that 2015 letter really shows a major institution grappling with so much at once. Immediate market turmoil, huge structural regulatory changes, absorbing that massive settlement.
While also managing costs.
That cleverly.
Seeing huge success in areas like M&A and asset management growth, betting big on technology and keeping these significant impact initiatives going.
It underscores that constant balancing act, doesn't it? Risk versus opportunity, regulation versus growth, talent development, all while trying to look ahead in a really uncertain world.
Absolutely. And understanding how they framed those challenges and opportunities back then, well, it gives you insights that are still relevant for watching these big firms navigate today's complexities.
For sure. Many of those fundamental questions they were dealing with, global growth, tech disruption, policy uncertainty, they haven't exactly gone away, have they?
Not at all. They're still very much on the table.
They certainly are. So, thinking about everything we've unpacked from this 2015 letter, what lessons do you, listening right now, think still apply in the financial world today, almost a decade on?